Right now, while you are watching this, a billion-dollar machine is trying to convince you that your eyes are lying. Pause. Stop what you are doing. Put the phone face down. If there is anyone in the room with you, tell them you need 10 minutes of absolute silence. Because the next 5 business days will determine who owns the silver market for the next decade and who gets left with a handful of digital dust. Size. Silver just hit $74. Do you feel that knot in your stomach? That is the sound of a mainstream narrative shattering. For 6 weeks, CNBC, Bloomberg, and every suit on financial television told you the bull run was over. They pointed to a 37% crash and called it a bubble popping. Sarcastic, they lied. That 37% collapse wasn't a market event. It was a clinical extraction, a premeditated, multi-institutional operation designed to trigger your sell reflex so the world's largest bullion banks could reclaim the physical metal they lost in January. Tonight on Market Crux, I am going to show you the kill chain. I am going to show you how they used the Iran conflict, the oil spike, and a fake interest rate narrative to engineer a controlled demolition of the paper price while the physical vaults were being bled dry. The rally to $74 you see on your screen right now, that isn't just a price move. That is the market screaming that the operation failed, the shorts are trapped, the vaults are empty, and the April reckoning is exactly 5 business days away. I'm not asking you to trust me. I'm asking you to look at the math. This is Market Crux. Let's look at the crime scene. To understand why $74 is the new floor, we must first analyze the wreckage of the March crash. Between March 12th and March 20th, silver didn't just correct. It was liquidated with surgical precision. When an asset class sheds $20 of value in 6 sessions while the physical demand in Shanghai is hitting record premiums, you aren't looking at price discovery. You are looking at a stop-loss raid. The goal was simple: separate the weak hands from the physical reality. The institutions knew that retail investors had piled into silver at the $85 level. They also knew that the technical support sat at $73. By orchestrating a massive short-selling campaign in the paper futures market during the illiquid Asian session hours, they forced the price through that support level. This triggered thousands of automated sell orders. This is the institutional playbook. You crash the price, wait for the panic to set in, and then buy back the metal at a 30% discount from the very people you scared into selling. But this time, they overplayed their hand. They crashed the paper price so far that they accidentally triggered a massive physical arbitrage between London and Shanghai. While the West was selling paper claims, the East was aggressively buying physical bars. The most dangerous weapon in the financial world isn't money, it's narrative engineering. To pull off the March extraction, the bullion banks deployed an 8-step kill chain to manipulate the psychology of the global tape. Step 1. The geopolitical detonator. They utilized the Iran-Israel escalation as the starting gun. By focusing every headline on the Strait of Hormuz, they created an immediate fear of energy disruption. Step 2. The energy spike. Oil prices were allowed to surge toward $100 per barrel. Why? Because energy is the primary driver of inflation expectations. Step 3. The inflation ghost. As oil rose, the inflation is sticky narrative was reborn. This was the ghost they used to haunt the markets. Step 4. The rate hike weapon. This is where the narrative becomes toxic. The media began quoting swaps traders who were suddenly pricing in 4 rate hikes from the Bank of England and a hawkish pivot from the Federal Reserve. Step 5. The opportunity cost myth. They hammered the idea that if rates are 6%, why own silver which pays 0 yield? This ignores the reality of negative real yields. Step 6. The algorithmic flush. Hedge fund bots are programmed to sell precious metals when the rate hike probability increases. The machines don't think, they just execute. Step 7. The media echo chamber. CNBC and Bloomberg provided the soundtrack to the crash, calling silver a failed trade. Step 8. The retail capitulation. This is the extraction point. You see the red screen, you hear the experts, and you hit the sell button. That is when your silver becomes their silver. While the talking heads were telling you that rates are going up because the economy is too hot, the actual ground-level data, the Purchasing Managers Index, PMI, was screaming the opposite. As of yesterday, March 24th, the flash PMIs for the US, UK, and Eurozone hit the tape. The results were a disaster for the rate hike narrative. The US Services PMI dropped to 51.1, its lowest level in almost a year. The UK Composite PMI shed nearly 3 points, signaling a sharp contraction in manufacturing. The Eurozone manufacturing PMI remains stuck in a deep recessionary zone. In what universe does a central bank raise interest rates into a synchronized global economic deceleration? They don't. It is mathematically impossible without causing a total systemic collapse. The rate hike narrative was a bluff, a psychological anchor used to suppress silver prices so that institutions could reset their short positions before the April delivery cycle. Tonight, silver is ripping 4% in a single session, and the bears are scrambling for the exits. Why? Because the first link in the kill chain just shattered. Reports indicate that Washington has sent a 15-point ceasefire proposal to Tehran. The war premium in oil is deflating as we speak. The moment the threat to the Strait of Hormuz decreased, the entire justification for the inflation spike and the rate hike fear evaporated. But look at the crux. Even as diplomatic signals improve, President Trump has ordered 2,000 paratroopers to the region. Silver is going up, not down. Why? Because the market has reached a point of realization. The smart money realizes those troops are there to secure the corridor, not start a war. They are a hedge against disruption. The rate hike bluff has been called, and the short squeeze of the century has officially begun. While the paper price was jumping around during the March crash, the physical vaults were telling a different story. As of this morning, March 25th, the COMEX registered inventory has hit a critical breaking point. We are looking at a total of 78.95 million ounces available for delivery. That sounds like a lot until you look at the open interest for the April delivery month. There are over 1,100 contracts representing nearly 10 million ounces of immediate demand. But look at the coverage ratio. It has fallen to 14.2%. For every 7 ounces of paper silver being traded on the COMEX right now, only 1 physical ounce actually exists in the registered vault. This is the definition of a fractional reserve nightmare. We are exactly 5 business days away from the April 1st notice day. If even a small fraction of those contract holders stand for delivery, the exchange enters a state of clinical default. We must also look at the industrial hunger for silver. While traders argue over cents on a screen, the world's most critical industries are running out of the nervous system of modern technology. The energy crisis in Qatar, following the missile strikes on LNG facilities, has caused energy costs to soar. Silver refining is an energy-intensive process. When energy prices spike, the cost of production for refined silver bars doubles. Furthermore, the green energy revolution is hitting a supply wall. Solar manufacturers in China are reporting that they cannot secure enough silver paste for their next-generation cells. The industrial world is now competing with the financial world for the same shrinking pile of metal. This is a zero-sum game. Historically, silver is a coiled spring. During the March crash, the gold-to-silver ratio widened significantly, hitting 65-1. To the untrained eye, this looked like silver was underperforming. To the market crux analyst, this was the buy signal of the year. Whenever this ratio stretches during a manufactured paper correction, silver eventually snaps back with 3 to 4 times the velocity of gold. With gold sitting at $4,180 tonight, a return to the historical monetary ratio would put silver well into the triple digits. The $74 move we are seeing tonight is just the ratio beginning to normalize. If you held your position through the 37% drawdown, I want you to recognize what you just achieved. You survived a coordinated psychological warfare operation. You didn't let a talking head on television dictate your financial destiny. But for those who sold, I know the feeling. I know the knot in the stomach. You were fighting a billion-dollar machine specifically designed to find your breaking point. The bullion banks win when you feel fear. But tonight, the machine is broken. The $74 price print is proof that the extraction failed to shake out enough metal to cover the institutional shorts. They are now the ones who are panicking. A warning to those holding paper silver through ETFs like SLV. You are standing on a trapdoor. Under normal market conditions, these ETFs track the price. But under physical stress, the kind of stress we are seeing with a 14.2% coverage ratio, these funds become a liability. When the London vault system starts to lock up, a paper claim on silver is not silver. It is a legal contract in a bankrupt system. The only real protection is the metal you can touch. Everything we have analyzed tonight points to a single conclusion. The Western financial system is operating on a buffer of lies. They assume that the world will continue to trade digital promises for physical reality forever. But the buffer is gone. The vaults are transparent, and the East has stopped playing the game. The rally to $74 is not a peak. It is the first step of a new reality. We are 5 business days away from a delivery cycle that could change the definition of money forever. The next 5 days will be the most volatile period in the history of the modern silver market. The bullion banks are in a death spiral, the vaults are bleeding, and the paper narrative is incinerating in real time. If you found value in this clinical breakdown and you want to stay ahead of the April reckoning, then do 2 things right now. First, hit the like button. It's the only way to tell the algorithm that this data matters, helping us break through the digital wall. Second, subscribe to Market Crux. We don't follow the noise, we don't follow the suits, we follow the vaults. On this channel, we provide the institutional intelligence you need to protect your wealth in an era of systemic failure. The paper burns, the metal endures. I'll see you in the next one. Market Crux, signing off.